Welcome to GITIXONE trading channel. Today I'll be talking more about the Fibonacci retracement tool. In our previous video, we looked at the history of the Fibonacci tool and how to use it to trade forex and crash 500 index profitably. Though it's common knowledge today that this tool is so powerful and can transform the way you trade, yet many traders still don't know when to apply it, hence the poor results they get. Note, I have not deviated from the break and retest strategy, which I have used different concepts to explain across all my videos. This Fibonacci retracement tool is just another concept of explaining the same break and retest strategy. I've taught shifts in market structure, fair value gaps, order blocks, supply and demand, liquidity concepts, and many other strategies here on this channel, just to explain to you that the market is simply break and retest, no matter the strategy you are using. You don't enter or exit the market arbitrarily or randomly. You enter or exit at previous levels of interest. These levels of interest are what we use different strategies to identify. These levels are plain to see with a bare technical eye and so do not require you be complex. So many people use support and resistance, some use supply and demand, some use order blocks, some use whatever strategy you must have heard about to identify all on this level. You can make money simply with the Fibonacci retracement tool as long as it helps to identify levels of interest. Hence, I'll be teaching you when to apply the Fibonacci tool today. Now let's go to the chart. The first thing you must identify whenever you open a chart is the trend. First, you must be able to identify the trend of the market. Looking at this chart before us here, this is an uptrending market. It is obvious to your eyes to see that the market is moving from lower prices to higher prices. Hence, the structure of an uptrend was created. Alright, so you can see low and then a high. You can see a higher low and then a higher high. And this one is a higher low, right? So this is the structure of an uptrend. Now, what do you do in this scenario when you notice that the market is in an uptrend? For you to be able to apply the Fibonacci tool after identifying the trend of the market, you must spot a clear reversal being created. Taking for example this move here, the move from this level, let me draw it for you to see. The move from this level to this level is a swing, all right? So this is a low and this is a high. I'm only going to apply the Fibonacci tool when I see a clear reversal. So not just one bearish candle or two bearish candle. No, you must see a clear reversal sign. The market is reversing downward, okay? Remember, you are not just seeing a sharp one candle returning or two candles returning. I mean bearish candles now. No, but you must see a clear reversal coming against the direction of the trend. Now, having identified that clear reversal, what you do is you take your Fibonacci tool and you place that tool, since an uptrend, you drag from the low, all right? Then you drag it onto the high. Now, what did you notice? The market returned back to the 0.5 level, which is also the 50% retracement level. What you must do is the third condition. I've mentioned two conditions so far. Number one, identify the trend. Number two, spot a clear reversal. Then number three, you will only enter at the 50% level or 61.8 level If it aligns with a previous order block, fair value gap, or support or resistance level, in the case of an uptrend, it's going to be a support level or a demand zone. All right. So now let's take a look at this region. Let's take a look at this region where the market retraced down to. So at this level that is at the 50% level, this region between the 50% level and the 61.8 level, what do you see toward the left? Now let's zoom in so that I can show you what I'm saying. All right, let's zoom in. Okay, so the market retraced to, this is a fair value gap. This is a fair value gap. Apart from this fair value gap, this is also a breaker, or what you can also call a previous supply zone turned, a previous supply zone turned demand zone, or previous resistance zone turned support, or what you can also call is more or less a breaker than it is a mitigation block, because it broke this low previously before it moved up. So this is a breaker. Now the market has returned to a breaker. For those that trade ICT, it has returned to a previous key level that acted as a resistance, which is now turned support. For those who are using support and resistance, or for those who are using supply and demand, this is a previous supply zone that has now turned to a demand zone. Okay, then this is also fair value gap. All of these concepts now, they are just different names to identify a key level where you can enter a trade. Simply with this Fibonacci 2 alone, you could have entered a trade. But normally, I would not enter without seeing any of these other confirmations. Do you understand what I just mean? So now, do you need to know about supply and demand, fair value gaps, liquidity, and all of this before you trade? No, not necessarily. All you needed to identify is another key level at the left where the market returns back to the 50% level or the 61.8 level. Then you find your buy or the continuation of the trend. Okay, so this is not the only scenario. We're going to spot other ones. Let me clean this chart. So that means for this particular move upwards that took place from here, you can imagine that a Fibonacci 2 could have helped you to identify this move. That's a 50% level. All right, now let's continue. Let's move upwards. This is another move. Let me zoom out for you. Is it zoom out or zoom in? Okay, let me zoom it. Now this is another move from here. No, it's an uptrend. Mind you, I've always taught you this channel that you should only seek to trade continuation patterns if you are not yet so much used to trading. Identify only continuation pattern. That means when the market is buying, only look for buy opportunities. When the market is selling, only look for sell opportunities. Okay, so right now looking at this, you can see that the market has taken a move from this low and it has gotten to this high, and here is a clear reverse and the market's returning down. So this is not just a spike downward, I mean a drop downward. No, there is no impulsive move downward. The market is taking its time to come down. That is what you should see. Remember, that is the second step. You must identify a clear reversal, and that clear reversal is not a rapid, steep fall, just one candle or two candles. No, it's going to be a set of candles that took time to come down. Do you understand me? So that takes time to retrace. That is how you know that this is a key area you can apply your Fibonacci to. Okay, so now what do we see on this particular one? The market was reversing down to this level and it got here to the 50% level again. Immediately it tapped into this level, we started buying. What do we see when we look to the left? If we look to the left side, we will see that this is an order block. This particular red candle that is here is an order block. Remember, I told you that an order block is very effective if after it forms and creates an imbalance or fair value gap alongside. So the moment an order block is created and there is a sharp fair value gap or imbalance alongside that creation of the order block, then it's a very good place for you to pay attention to. And this is one of such places. Okay, so we can see by what we have already known before now in this channel that this is the order block the market came back to but it also aligned with the 50% retracement level of the Fibonacci tool. So if you are the kind of person that pays attention to trading alongside a trend, you would have caught this powerful move, very long move, and you would have also caught the other one, this other side. In case you missed this first one, here's going to be another one, maybe 2 weeks later, because this is a 4-hour time frame, and this is a volatility 25 index. Okay, you can still do this on foreign exchange. Of course, I'm going to show this to you on a currency pair as well. You can do it on any asset, and you are going to find that the result is the same. All right, so let me remove this particular Fibonacci tool now, and you will have seen how clean and clear you have identified this move upwards. Let's show you another one. Let's measure this particular one upwards. Let me delete this now. All right, so let's measure this particular one upward. This is Fibonacci tool from the low, and then we'll take it to the high. Okay, what do you see? Let me zoom in for you to see properly. Let me zoom in. All right, so you can see that the market actually retraced down to the 50% level or the 61.8 level, which are the two levels I told you that you should pay attention to. That's the third condition. I mentioned 3 conditions. After you've noted the trend of the market, you must spot the trend, you must know the trend. Secondly, you must see a clear reversal. And then number 3, only pay attention to the 50% level or 61.8 level. Now, at that 61.8 level, what do you see? Ensure that it aligns with a previous order block, fair value gap, support or resistance level, or other blocks and whatever. This is another one. This is another block. Okay, so the market came back to this other block, and then this move again continued. All right, so the market is like this every time the market is in a trending environment. Okay, so I've told you that you do this in a trending environment. That's when to apply the Fibonacci tool. You don't apply the Fibonacci tool arbitrarily or randomly to any price movement. No, you must ensure the market is trending upwards, and then all these other conditions I told you must be aligned. Okay, so I will try and show you one last one with this particular asset before I move to show you on currency pairs. Okay, now this is not the reverse of the case. This is a downtrend. Now the market has reached a climax, a high, and it came down to a previous low. Then tried to buy, but it couldn't buy. It broke it down also. This is a shift in structure, all right, which I've also taught in this channel. So this is a shift in market structure. The idea is for us to wait for the pullback or the retracement, and then for us to sell. Now you can use the Fibonacci tool to know exactly where to buy, where to sell this market. So you take it from where the move began at the top here, you drag it to the bottom. That's for a downtrend. You drag from the top to the low. All right. So now what do you see? This is the 50% level. Let me zoom in for you to see. All right, so this is the 50% level or 61.8 level. Now, if you look to the left, you will discover that the market is also in an area where it has created previous order blocks, 1, 2 order blocks. And here also is, let me do this. Here is also a previous mitigation block. This is a mitigation block because the move it created before didn't take out any high before coming down. So this is a mitigation block. This is not a breaker. I don't need to be teaching you what is a breaker or a mitigation block at this level. There's a video that explains all of that in this channel. You can go and watch it, okay? So, but you see that before this market started pulling down, it came back to an order block at this other side before it started coming down. I told you the market do not just move randomly or arbitrarily. It comes back to previous price levels to do continuation or reversals. So I want to still repeat again that all strategies, whatever the strategy is going to be like, is simply going to be telling you how to trade pullbacks, how to attempt, break, and retest. If it is another block, it will come back to retest the other block before you buy. All strategies are simply retesting previous levels. And as long as you can identify this in your trading, you will be able to do well, okay? So let me go and show it to you also with a currency pair. This is GBP JPY. Will I be able to spot a place? Let me see. GBP JPY. All right. So okay, let's use this to explain. Remember, the market is trending upwards, okay? It's trending upwards from all of these levels. You can see that the market is going up, all right? You can see that the market is going up. Am I correct? So now the market has been moving on. Let's see this particular one. The market retraced back from this level here. It moved from here to this place. What did it do? The market retraced back to the 61.8 level. Are you seeing that? So, and what's in that level? A previous order block. Remember that the order block led to the creation of an imbalance, or what you can call a fair value gap. Do you understand me? So, and then what did the market do? It bought from here massively. Okay, so that's for that one. Now, let me look for another one and show to you. Okay, let me also show you the ones that failed, so that it will not look like it always works. It doesn't work 100%. So this is a move from here to this point, and market retraced back to 61.8 level. Are you seeing this? 61.8 level. And what is that level saying? That level is a previous order block. A previous mitigation block. And you can also see other blocks here. So the market decided to go up a little, but it didn't go up for long. It came down and violated our entry. That means we would have lost this particular one. All right. So now let's go to another one. Yes, this is another one here. The market moved from this low down up to this high here. Okay. So the market retraced down to this 61.8 level again. And you can see that the market also left us an order block in that same area. Okay. So, and those other blocks are very important. They are very, very key. They are very, very important. Okay, look at it. Another block, and then a bot. You would have hit your TP on this one. All right. So let me also look at other ones. Yeah, let's look at other ones. Let me remove the drawings. Okay, so let's look at the other one here. The market moved from here up to this level. All right, and it was retracing down. We traced down again to the 61.8 level. And what is in that 61.8 level? You can see it here. All right, a previous supply zone, or what you can call a previous resistance. Or you can also see another block here. All right, you can see it there. Let me zoom it for you to see. You can see that there is another block here before the market started buying aggressively. Okay, so the market always respects the 61.8 level or the 50% level. These are the two most important levels on your Fibonacci tool. Remember, there must be a clear reversal. It must be a clear trend, and you must see all of these. These are the three conditions that you should. So I'm going to highlight the three conditions again after this statement. You should be able to see them now. First condition, after you note the trend must be clear. Then after you know the trend, you must also see a clear reversal. And after you see a clear reversal, you begin to check at the 50% level or the 61.8% level. Let me remove this drawing. I'll show you this last one before I close this class. Okay, so look at this. The market is moving from here up to this level. All right, and it retraced down again to this 61.8 level. And what do you see? Previous price action is here. These are previous levels. Okay, so the market just tapped into the other block that is here. This is the other block it tapped into. This other block. Merely tapped into it, voila, it bought upwards. All right, it would have hit your TP as well. This is how you can apply the Fibonacci tool. This is when I've shown you the how in my previous videos, and I'm just repeating myself, but I'm showing you again the when to use it. And these are the three conditions at which you use the Fibonacci tool. So if you have watched up to this point, please, I would like you to comment the word thank you. And once you comment that, I'll give you a heart. Thank you so much for watching. God bless you. Until I meet you again, happy trading.